Back with the market right here on ET now. It's a tempered global setup, even though the SGX Nifty may be indicating a quiet start. Asian cues mixed, but weak for the US equities. But let's try and analyze the other bit of news which could move the markets. The Income Tax Department has dropped a $1.6 billion bombshell on Cairn Energy using the controversial retrospective tax laws, a move that has sent shockwaves through the international investor community, and one that may even ruin the goodwill earned by Finance Minister Arun Jaitley through his progressive tax proposals in the budget. Ashwin Mohan joins us now for more details. And Ashwin, this is definitely not good news for the markets from a policy standpoint.
Received a post-budget shocker from the Indian income tax authorities. We understand that the subsidiary has been slapped with a draft assessment tax order of a whopping $1.6 billion, including interest as well as penalties. And we understand that this is for fiscal year 2006-2007. Now, what is interesting is that, according to the Cairn statement, this particular $1.6 billion tax order has its origin in the controversial retrospective tax laws that had been introduced in earlier budgets. In fact, let's not forget that this time around, there was a demand that law should be scrapped, but that law stayed. It wasn't scrapped by Arun Jaitley in his first full year budget. We also understand that the transaction under scrutiny, as far as this sudden order is concerned, was the group restructuring, which is required to enable the IPO of Cairn India back in 2007. Now, Cairn has taken this sudden tax issue really seriously. We understand that it has, in fact, decided to file a notice of dispute under the India-UK Investment Treaty. In fact, Cairn says that it continues to be restricted by the Indian Income Tax Department when it comes to selling its 10% shareholding in Cairn India Limited, which is currently valued at $700 million. Cairn also pointing out that it does not intend to make any accounting provisions as a result of this particular order because it feels it's adequately protected as far as international law is concerned. But clearly, this move by the Income Tax Department will have a huge impact as far as investor sentiment is concerned, because remember, the current government wanted to, in fact, avoid any sort of tax terrorism. They wanted a reasonable and fair tax regime, and clearly the ghost of the retro tax nightmare is back to haunt MNCs as well as India Inc.
Well, thanks for that, Ashwin. Mukesh Butani, managing partner at BMR Legal, joins us right now. And Mr. Butani, thanks for joining in. Is it that big a shocker? I mean, how would you rate this move by the Income Tax Department?
So there are two aspects to this debate. One is specifically with respect to the law part of it, and second is what Cairn intends to do. As far as the retrospective law is concerned, this year's budget clearly signals that the only concession the government is willing to make is implement the recommendations of the expert committee, and the expert committee, amongst various recommendations, had put out a threshold of 50% and exempted small kinds of transfers. It did not exempt any form of reorganization as such. So the government intention is very clear that it wants to go ahead with the retrospective law. The second aspect that was announced last year is that, to the extent there is a Showcause notice being issued, it will be examined by this committee, and if people have chosen to adopt the route of judicial remedy, then the courts will decide the matter. So the government's intention is very clear that these are basically the 2-3 options that are available to a taxpayer, and the larger expectation of the investor community that this law be completely withdrawn is something that doesn't seem to have cut ice with the government. Now, what Cairn seems to have done over here is that they resorted to judicial remedy in 2013 when they filed a writ petition in the Delhi High Court questioning the constitutional validity of the retrospective law. At that point in time, they withdrew the writ petition, and now they seem to be invoking the India-UK bilateral treaty. Remember one thing, the dispute is at two levels. It's at the buyer level and it's at the seller level. At the buyer level, the dispute is at the UK level. And at the UK level, they have chosen to invoke the India-UK bilateral treaty because clearly under the income tax law, the retrospective law, this transaction is taxable, and hence the department has gone ahead and raised the demand. Now, what they are seeking as a relief at the bilateral investment treaty level is by saying that as a result of the retrospective law, their investment has got impaired, and hence they have the right to invoke the bilateral treaty. So they are going about in a manner by saying that we are sending the notice, and this will lead to appointment of arbitrators, and the matter will go to the International Arbitral Tribunal, exactly on the same lines as it has happened in Vodafone's case. Now, the primary argument from the Indian government side is that you cannot bring a tax dispute within BPA. Now, so, the Indian government is questioning the jurisdiction whether a tax dispute can be brought under BPA. Now, that is for the arbitral tribunal to decide. So, Cairn really has got two-pronged strategy. At the buyer level, invoke the India-UK treaty, and at the seller level, I think they may possibly revive the writ petition in the Delhi High Court, which they had withdrawn last year.
So, Mukesh, I mean, the good part is that Cairn India, the listed entity, does not get impacted. It's Cairn PLC, which has been slapped with the tax. But purely from a market perspective, do you think this is not going to go down with the international investor community? Because this may sort of damage, the government's tax policy stance.
I don't know, whether it will cause a damage of the nature and the magnitude you're talking about, because I think the law is very clear now. They have pressed the button on the implementation of the law. Now, whether you like it or not, I mean, most investors obviously don't like the retrospective law. But the fact that the retrospective law has not been withdrawn signals government's intention to go ahead with the law. So that intention was made very clear as a result of budget announcements in July 2014, and it's even more clearer in this year's budget, because they are not just saying that we are going ahead with the law by not withdrawing, but we are also implementing the Showcause committee recommendations as to how the law will be implemented. So the fact that it has come as a shocker is an outcome of the decision taken in the budget itself.
So you don't believe that this will have any kind of negative repercussions on the international investing community? They wouldn't take it too badly.
Well, ideally, if you look at it from an international investor community standpoint, the expectation was that the law will be repealed completely. But what I'm trying to say is that the fact that the law was not repealed, and the fact that the government decided to press ahead with the law, itself was clarified in the budget.
So it's not new news. It's something that was anyways
anticipated.
It's not new.
The government is merely implementing what it said.
Right. Okay. Great. Thanks for putting that into perspective. Really good having this phone with you early morning, Mr. Butani. Thanks for joining in today.
Welcome.
Well, that's Mukesh Butani saying that, yes, it is not something that maybe the international investor community would like, but this is known. It's not something that's come out of the blue, so may not be as big a shocker for the international investing community. Not bad, really.
As Ashwin thinks it would be.
Yeah, so it's not clearly. But anyways, let's probably pays to examine both sides of the story as well, I guess. Let's take that very, very quick break. We come back, get in Mr. BP Singh of America Mutual Fund to speak about the other aspects of the market.